Welcome to the WTR Small Cap Spotlight podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. In today's podcast episode, I have the pleasure of being joined by Zak Calisto, founder and group CEO of Karooooo Limited, NASDAQ, ticker symbol KARO. Also joining us is my WTR equity research colleague, Eric Goldstein. Karoo is a Singapore-headquartered global connected vehicle and fleet intelligence platform built on the foundation of Cartrack, one of the world's leading SaaS telematics businesses, with roots going back over 2 decades in South Africa. Today, Karoo serves more than 2.6 million subscribers across Africa, Europe, Asia, and the Middle East, delivering real-time vehicle tracking, driver behavior analytics, workflow automation, and a growing portfolio of data-driven services, all on a highly recurring subscription model, very importantly. The company just reported record fiscal 2026 results, with Cartrack subscription revenue accelerating 19%, annual recurring revenue reaching $325 million USD on a 38% increase in dollar terms, and adjusted free cash flow increased 90% to ZAR 809 million. The board raised its annual dividend 20%, telegraphing management's confidence ahead. Finally, Karoo provided a 2027 fiscal year outlook that implies accelerating Cartrack subscription revenue growth and 21% EPS growth at the midpoint. So let me start things off by welcoming Zak and Eric to the podcast. Good morning, gentlemen.
Morning.
Good morning, Tim. Thanks for having us.
Yeah, Zak, great to have you here. And let's kick things off by me asking you to tell our listeners a bit about the company. Can you give us a high-level overview of what the company does, including the core business, the problem you're solving for customers, and why connected vehicle and fleet intelligence matters more today than ever before?
We started the business approximately 20 years ago and started off very much of a track and trace company. And clearly, we've built this business from the ground up. Every single quarter in the last 20 years, we've increased subscription revenue. Obviously, our platform is today not what it was 5 years ago or 10 years ago, and we continue to invest in our products, our platform, and fundamentally, we just help our customers drive operational excellence in their businesses. So we digitalize their business operations, and we give them business intelligence reports that help them drive their business. And like you said, importantly, 98% of our revenue is subscription revenue.
Great. Well, thank you for that overview. I got to say, it's a very interesting company, and the subscription numbers are really quite impressive. So over to you, Eric.
Okay, thanks, Tim. And Zak, thanks for joining us today. You've built a super impressive business, and we really appreciate your time. So just to get things started, if you can take us back to the founding of Cartrack. You started this business in South Africa over 2 decades ago. What was your original thinking that drove you to build the business, and how has the business evolved since then? And what does the NASDAQ listing as a Singapore headquartered company mean for the organization?
So we started the business in 2004. It was very much a track and trace company. The type of equipment that we had at the time was world-class, world-leading, and we had a very good platform at the time. However, that platform, by 2007, we moved into fleet management. And since then, every month, every year, we just continue to improve the platform, include and rewrite the platform. We've probably done that about 3 times. But fundamentally, our platform today has evolved into a world-class platform to really help businesses mitigate their risk, increase productivity, and compliance. And I'd give the business owners full visibility of their business with great intelligence reports and AI embedded software that helps them to make better decisions. So fundamentally, and we continue to invest in the platform. And I think what's important for our business is that the data points that we have, we collect them, so they're not publicly available. So we believe that's a very strong point, specifically in the AI world, where AI, we believe, is a tailwind for us. And, the data points are proprietary to our ecosystem. So we also do manage all the IoT devices in the field that collect these data points. And like I said, these data points aren't available freely to any other competitor.
Okay, that's great. So just building on that, can we just discuss what makes the Karoo platform proprietary and difficult to replicate? So if you can walk us through the technology stack, device hardware, data layer, SaaS applications, and just explain, why the moat is so defensible, and how does the data you've accumulated over the last 20 years compound into a real competitive advantage for your company?
So we design, manufacture our own IoT devices. Some of the IoT devices, we give it to third parties to manufacture for us, despite it being our design. These devices, we have well over 1,000 auto electricians in the field. I think we've got at the moment just around 2,000 auto electricians in the field that are installing these devices into vehicles. And these devices collect the data points that are necessary for each customer's business. Every business, every business is run differently by its management. So there's a bespoke way that we install devices and which devices we install for the business. So these data points are very specific to the way management wants to run their business. We then get this data, and this data then gets processed in the cloud so that we can give the customer the business intelligence reports that he would like. So that really is our business model, obviously on an annuity basis. So in order to compete with us, you need the distribution, you need the installation and the maintenance of the hardware, and you also need a platform. Plus, you need the distribution, which is really the salespeople actually going to see customers. What's also important in our business model, a customer that, for instance, got 1,000 trucks, he probably gives us $10,000 a month. Even if he had to run his own AI team, the one individual working for him would cost him more than $10,000 if he only had one person. Plus, he still needs all the auto electricians. So it doesn't really make sense for a company to do it themselves, even if they wanted to do it themselves, given the low cost and the value proposition that we give to our customers.
Makes perfect sense. So just building on that, can you kind of walk us through who the Karoo customers are, the end markets you serve, who are the fleet operators, large enterprise companies, maybe some government customers, and how the use cases and the value proposition differs across the segments and geographies from South Africa to Europe, Asia, Middle East?
So our customers typically are business owners, and it can be quite a small business, and it can be a very large enterprise. Our largest customer in terms of vehicles got 33,000 vehicles, and one of our largest customers is the Singapore government, which has probably about 10,000 IoT devices on to manage all the government fleets. So in terms of, we got Coca-Cola, we've got quite a large enterprise customers with 2,000, 3,000, 4,000 trucks doing different things, whether it's a police force or whether it's an ambulance service or whether it's bio waste or whether it's cold refrigeration or whether it's retailers. So it's really, we have no concentration of a specific industry or a specific customer. And our platform has been designed in such a way to keep it simple for any customer to be able to use it irrespective of industry. So it's quite a broad platform that talks to different industries. And obviously, as we continue to develop and get closer to our customers, we realize that the challenges that all businesses have are never ending. So we just continue to develop. And while we started off not being in industries specific, we now, as we get closer to cement mixers or bio waste, we're starting to become specialized in all different types of industries, because it's every year, every month, we're just coming out with more features as we get closer to our customers to address their challenges.
Okay, that's great. So beyond the Cartrack business, you have Karoo Logistics. So this is your delivery as a service business, which grew by roughly 29% in fiscal 2026 and 50% on a US dollar basis. So can you explain what that business actually does and how it differentiates from the pure play telematics business? And how do you think about it strategically within the broader Karoo group?
So we have a lot of large retailers as our customers. And during COVID, it became very apparent that a lot of these customers wanted to do e-commerce. They also didn't want to be doing e-commerce through the broader platforms. They wanted their own brand, and they wanted to control on one single platform their own vehicles plus their third-party drivers. So Karoo Logistics is really the platform for third-party drivers to give our existing customers visibility on their full logistics, needs. In other words, they're able to manage their own vehicles, and they're also able to see exactly what's happening to the delivery of their goods. And it allows them, it gives them the elasticity that they need to expand when they might have orders bigger than their own fleets, or it allows them just to outsource part of their business, which is the full delivery as a service business. And these drivers typically will dress up in the clothing of the retailer that they're actually servicing. So if you, for instance, order things through Pick and Pay, one of the large retailers, then they will arrive at your home dressed in a Pick and Pay uniform. So all of that is managed by us.
Okay, that's great. Thank you. So just taking a deeper dive into the 2026 results, your Cartrack subscription revenue grew, or actually accelerated, to 19%, up from 15% the prior year. And in South Africa, your annual recurring revenue exited the year growing at 23%. So these are some really impressive numbers, despite being held back by the strength of the South African rand. So what specifically drove that inflection? Was it go-to-market changes, product expansion? Was it just better execution? And why should investors view this as a durable type of growth rate rather than just a one-year bump?
We invested substantially during FY26 on broadening our ability to distribute. So that's the one factor that drove. So you will see that our increase in sales and marketing was in the region of 45%. So that's the one element. The other element, we also brought to the market one of our products, which is the tag. We brought it to the market on a commercial basis. And obviously, we started driving our AI video offering stronger in FY26. We have given outlook that talks to further accelerated growth in this year. And we are going to continue to drive growth. And above all, we're also going to be driving efficiency of the huge increase in sales and marketing we had last year. So we certainly have given outlook where we believe we're going to continue with the momentum.
Okay, that's great. So just taking a look at your free cash flow and your capital returns. So it looks like your adjusted free cash flow was up 90% to 809 million Rand in 26. And you raised your annual dividend by 20% to $1.50 in US dollars, payable in July. So what drove the cash flow inflection, and how repeatable is that going forward? And what message does the 20% dividend increase send about your conviction in your earnings trajectory going forward?
I think the most important thing, Eric, is that in the prior year, we're still finishing off our regional head office in South Africa for the South African market. That was a substantial investment that we did, and it's already paying dividends with the growth in South Africa of 23%. And that 19% growth you spoke about, Eric, that's actually obviously lower in constant currency. It's higher because of the stronger rand. And so we didn't spend on the building, so that's didn't drain the cash. The prior year, because we were planning for the accelerated growth in FY26, we put in a substantial amount of money into inventory to drive the growth in FY26. So inventory was, I wouldn't necessarily say better managed, but we weren't accelerating the drive in inventory for future growth. We've now got good control of that inventory, and we don't have to drive it up as much for the accelerated growth. It will be a more gradual increase. And we also negotiated better terms with our suppliers. So overall, you get that 90% growth, but I mean, we can't expect the same thing in FY27. It's now been maximized, and now it will be more in line going forward. So it's nearly like it's normalized rather than anything else.
That makes perfect sense. So let's take a look at your guidance and EPS kind of going forward. So for fiscal 27, you're guiding Cartrack subscription revenue in South African rand of between 5.7 to 6 billion rand, which implies growth between 18 to 24%, and adjusted EPS growth of approximately 21% at the midpoint. So what are the key operating levers that get you from the 3% EPS growth you reported in 26 to 21% at the midpoint for 27? And how should investors think about the cadence of the ramp throughout the year? And also, can you touch on the benefits you're seeing from some of your cross-selling activity with products such as driving video and your Cartrack tag going into your existing customer base?
I think fundamentally, Eric, we're looking at increasing very much in line or strongly correlated to our subscription revenue, our gross profit. However, in our OPEX, we're not going to get the same increase in sales and marketing that we had in the prior year. So there's going to be quite a bit of arbitrage between the higher increase in gross profit against the lower increase in OPEX. And that will result in a substantially better earnings when reporting in IFRS. And that is where we get our confidence in being able to deliver stronger earnings per share. And if you look back, Eric, we've traditionally grown our earnings per share, over 20% in the last 4 years. So this would be no different. And the reason our earnings per share only grew by 3%, it was because we really accelerated and invested in our sales and marketing, and that expense is not aligned to subscription revenue. So, those customers we acquired during FY26, that revenue is going to go for many years to come, whereas the sales and marketing has been expensed up front. Then talking about our tag product and our Cartrack video, we probably have a penetration into our base at this point in time of about 3 to 4%. So we still have a long way to do cross-selling. And over and above that, we've typically never upsold our features, unlike our American peers that every time they have a new feature, they try to upsell it to their customers. We've always more focused on a value proposition to our customer and given those features for our customers for free. we also have that opportunity at any given time that we can start driving more revenue out of more enhanced features, something we haven't done in the past.
Okay, that's great. So let's take a look at the international expansion. So in Europe, you grew subscription revenue by 22% in fiscal 2026. And Asia and the Middle East grew by 17%. So these remain smaller bases relative to the South African business. So which geography do you view as the biggest greenfield opportunity over the next 3 to 5 years?
Uh,
And what investments are you making to capture that?
So, Eric, our biggest opportunity is definitely the Asia region. Those percentages you gave, they basically in rand. So you've got in constant currency, it actually like Asia grew more. Also, the growth you see in Asia is a bit muted. Our average revenue per subscriber in Asia is at this point in time much higher than in South Africa. But over time, that will drop to be more in line with South Africa as countries like the Philippines, Indonesia, Malaysia, Thailand grow. And they are growing much faster than countries like Singapore and New Zealand, which have got very high ARPUs. When you compare the revenues we generate from our customers in Singapore and New Zealand, they're substantially higher than a customer from Thailand, for instance. So as those countries grow, then our average revenue in Asia will come down slightly. And eventually we imagine it to mirror more or less the same ARPUs that we get in South Africa. So I think with growth and long term, with FX out of the way, I think that we definitely believe that Asia is the biggest opportunity for us.
Okay, that's great. So let's just talk about your data. You're sitting on years of behavioral data across 2.6 million subscribers. How is Karoo thinking about monetizing that data set, possibly through AI-driven features, insurance partnerships, new SaaS modules? Is any of that optionality embedded in the 2027 guidance, or is that upside to the plan going forward?
So fundamentally, we only use the data at this point in time to create business intelligence reports for our own customers. See, we have huge demand from a lot of different companies and interest in getting anonymous data from us. We haven't gone down that route. We actually stay away from it because we see that as a distraction at this point in time. But this data is used for our business intelligence reports. We're using it for our AI tools. We've created a lot of AI tools and continue to create those. At a later stage, we could obviously see the opportunity to use this data for the benefit of creating revenue, but we're not quite there at this stage.
Okay. So final question. So as we look out over the next 12 to 18 months, what are the specific milestones or proof points that you would tell investors to watch closely as evidence that Karoo is executing on its strategy and that the thesis is playing out as you envision it?
I think the good thing, Eric, is we've got 20 years track record of being profitable and executing. We've always told the market our outlook. We've never missed our outlook ever. And I think the things to watch us for is the accelerated execution and us improving our platform and our products. And it's really what we've been doing for 20 years, the continuous build-up of our distribution capabilities. We are vertically integrated. We don't rely on third parties to help us build our business. And continuously focused on product in order to improve our business and our offering and to stay ahead of the game. So it's what we've been doing for over 20 years now.
It's amazing. Well, Zak, I just want to say thank you. You have built a really very impressive business, And we really appreciate you walking us through the Karoo story and all the important dynamics that are driving your business. The combination of your accelerating subscription revenue, your strong free cash flow profile, and a clear runway that it seems like you have for the international expansion is a compelling picture for investors to think about. So thank you very much.
Thank you, Eric, and thank you, Tim, for having me on the call.
Yeah, thanks. Thank you, Eric, for those thoughtful questions, and Zach, very interesting answers. I would mirror actually what Eric said. Your story is new to me, but boy, that track record is really, really impressive. So congratulations.
Thank you, Tim.
Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to stay up to speed on the company's small cap written research reports, podcasts, fireside chats, industry-specific symposiums, and conference schedules. We will see you next time for another edition of the WTR Small Cap Spotlight podcast. Finally, a special thanks to the producer and editor of the podcast, Krista Fitzpatrick.